We have been borrowing from the past to today. So who is the creditor? Every country in the world is in debt. The United States is currently in debt of more than $38 trillion, the highest in its history. The European Union carries roughly $14 trillion, Japan nearly $9 trillion. Even oil-rich nations like Saudi Arabia or export giants like Germany and China are burdened with enormous debt. But here's the paradox. If everyone is in debt, who exactly are we indebted to? This is where money, power, and history collide. And nothing is as simple as it looks. Debt is not just a burden. It is the architecture of the modern world. Every war, every crisis, every rise and fall sits on this invisible scaffolding of EOUS. And if you follow the chain of creditors long enough, you discover something unsettling. The world is not really indebted to anyone. It is indebted to itself, but that doesn't mean everyone benefits equally. To understand how a planet drowning under more than $315 trillion, nearly 3 times the size of the global economy, reached this point, we need to go back to the beginning long before the first credit card swipe or digital transfer. The idea of national debt was born not on Wall Street, but in war. In 1694, England was at war with France and running out of gold. The king turned to merchants for help. In exchange for perpetual interest payments backed by future taxes, they financed the crown. To manage this new arrangement, the Bank of England was created. It was revolutionary. The state could now spend money it did not yet have. Lenders in return received something priceless, a government promise that could be bought and sold. This was the birth of the government bond, the seed of the modern financial system. France copied it. The Dutch perfected it. The newly independent United States adopted it to finance its revolution and westward expansion. National debt became not a sign of failure, but a measure of credibility. The ability to borrow became the ability to govern. Empires once conquered land to dig up gold. Now they issued bonds to collect interest. The battlefield became the balance sheet. Fast forward 3 centuries, and debt has become the world's dominant export. The United States owes $38 trillion, Japan over $9 trillion, and global debt increases by roughly $1 trillion every 100 days. Every country is in debt. Every bank lends. Every citizen, through taxes, savings, and pension funds, is both borrower and lender. So who exactly holds the other end of the rope? Let's start with the United States because its debt is not just national, it is global. Of that $38 trillion story, about half is public, owed to investors, not government agencies. About 2/3 of these investors are American banks, pension funds, mutual funds, insurance companies, and the Federal Reserve itself. The remaining 1/3, around $9 trillion, is held by foreigners. Japan is the largest holder with about $1 trillion, followed by China with about $800 billion, then the UK, Luxembourg, and Belgium. So when people say the U.S. is in debt to China, that's true, but only for about 2% of the total. Most of America's debt is owed to America. The Treasury issues bonds, banks and funds buy them. The Federal Reserve often buys them back, creating new dollars in the process. Americans pay taxes that fund the interest, which then flows into American retirement accounts. It is a circular mirror. The debt is real, but the creditor is mostly a reflection of the same system. And this circularity is not uniquely American. It is global. Japan lends to the U.S. through Treasury bills. The U.S. lends to Europe through the IMF. Europe lends to developing countries through the World Bank. Developing countries lend back to advanced economies by storing foreign reserves and Western bonds. This is a planet-wide game of hot potato, except the potato is made of promises. Every country holds another's IOU. Every promise is backed by another promise. It's like a poker table where every player borrows chips from one another, and the only rule keeping the game alive: no one stands up. But there is a 4th layer, the most powerful: the markets themselves. Behind every government bond lies a network of institutions, hedge funds, pension funds, sovereign wealth funds, and central banks managing tens of trillions. They are the true referees of credit. They determine which countries borrow cheaply and which pay a survival premium. When they lose confidence, currencies crash, governments fall. fall, and entire economies are rewritten overnight. Democracy decides who governs. Markets decide who survives. And the biggest market maker, the high priest of the modern system, is the central bank. Central banks don't just manage debt, they create it. When the Federal Reserve or the European Central Bank buys government bonds, it creates new money in exchange. One balance sheet's liability becomes another's asset. Every dollar in circulation represents a unit of debt somewhere else. There is no such thing as money without debt. Every coin, every bill, every digital dollar has an invisible IOU engraved onto it. This cycle has survived for decades because of one ingredient: trust. As long as investors believe governments will pay interest, even if they never repay the principal, the machine keeps running. But what happens when trust breaks? We've seen it before. In 2010, Greece's government debt became unpayable. Bondholders panicked. Yields exploded. The European Central Bank and the IMF intervened. But salvation came with austerity. Tax hikes, spending cuts, mass unemployment. An entire generation learned that bailout is just another word for sacrifice. In Argentina, repeated defaults turned debt into a national curse. In Sri Lanka, when the government ran out of foreign currency to service loans, fuel shortages and political collapse followed. When the system breaks, creditors become visible. The IMF, rating agencies, and faceless bondholders gripping entire nations by the throat. Yet even after collapse, the same logic resumes. New loans replace old ones. Old debts are restructured. The machine resets with a new name on the same balance sheet. Because in the 21st century, national debt is not designed to be repaid, it is designed to be rolled over. When you or I borrow, we're expected to pay back the principal. Governments work differently. They treat debt like a subscription, issuing new bonds to pay off old ones, a process economists call refinancing. Interest becomes the real product, the rent paid for stability. And the global economy depends on this rent, like a shark that must keep swimming to breathe. Today's financial system runs not on repayment, but on confidence. The U.S. will never pay off its $38 trillion debt. Japan has been rolling over its debt for decades, now exceeding 250% of its GDP. Yet bond yields remain near zero. Investors don't expect repayment, they expect renewal. Why? Because government debt is the safest collateral on earth. A U.S. Treasury bond is not viewed as a liability, but as an asset, the backbone of global markets. Pension funds hold it. Banks use it as collateral. Central banks treat it like money. The system relies on governments never paying down their debt, because if they did, the world would lose its most reliable financial instrument. Imagine Washington deciding to pay back every last dollar of its debt. Banks and funds worldwide would lose their most stable asset. The supply of dollars would contract sharply, triggering deflation and collapse. Paying off the debt would destroy the very thing that makes the economy function. So governments do the opposite, not recklessly, but rhythmically. Issuing more bonds, debt becomes the heartbeat of capitalism, pulsing through every pension, mortgage, and market on earth. This is why politicians promising to balance the budget or pay off the national debt are selling an illusion. The goal is not to eliminate debt. It is to keep it sustainable, tradable, and desirable, so the belief in it never stops. Because when belief fades, numbers stop mattering, confidence collapses, rates rise, and an economy built entirely on promises grinds to a halt. Here is the real secret of sovereign debt. The plan was never to repay it. The plan was to keep the world believing it would be repaid. This is a closed loop of confidence. And as long as confidence remains, the numbers can stretch into infinity. But confidence is not distributed equally. When we say we owe it to ourselves, that is only half true. Interest payments do not flow evenly through society. They move upward, from taxpayers and workers to institutions and investors holding the debt. Debt is not just a transfer between nations. It is a transfer between classes. This is why global inequality and global indebtedness rise together. The system rewards those who hold debt, not those who repay it. If that sounds familiar, it's because it is the same story at every scale, from households to nations, from nations to the entire planet. Creditors are not villains. Debtors are not victims. They are two sides of the same engine. The problem is what happens when the engine runs out of fuel. When new borrowing can no longer manage old promises, that is when the question, who is the creditor, stops being abstract and becomes personal. Because at the top of this global pyramid, there is no single face to blame. Not China, not Wall Street, not the IMF. It is all of them and us. Modern finance has turned debt itself into money. Governments issue debt. Banks multiply it. Investors trade it. Citizens depend on it. The line between borrower and lender has blurred beyond recognition. Debt once meant bondage. Today it means balance. But if that balance breaks, if confidence cracks, the illusion shatters, and we are reminded of what debt truly is. A promise that cannot be kept forever. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.